Greetings everyone. In this video, let's be more, so to speak, philosophical about financial markets, and let's talk about one important theory which is actually perceived as a truth by many important minds of finance. I don't know if it's the best description for that, but it goes something like that. And this theory is random walk hypothesis. I will quote in one sentence what Wikipedia says about it, and then I will go to more simpler explanations. The random walk hypothesis is financial theory stating that stock market prices evolve according to random walk, so price changes are random and thus cannot be predicted. What that means for a non-financial professional? Well, it means that actually there are no patterns or logic in financial markets, at least in the present time and present situation. Like, we could be smart after the fact, but no one knows the future, and when we are at current state of affairs, no one actually knows everything, and every kind of forecast and everything that relies on market forecasts are foolish. Well, this is my subjective interpretation of this interpretation, but that's the thing. Because what random walk means on theory, random walk means that's a theory when you flip the coin. If it goes tails, you are stepping at one side. If it lands on heads, you go on other side, like left or right, and this is random walk. That's why it's called random walk. You flip the coin and you are walking randomly according to where coin says you are. And the theory is that financial markets move the same. They are completely random and chaotic. Question is it true? Well, that's actually a very good question. There are two types of people. That people are saying that that's complete nonsense. I could forecast markets in the split second because I know every possible move what might happen, and there are people who laugh at that and says that if you actually properly tested it, nothing might work out of that. And those people who are the second category usually are smarter than the first category, at least in context of financial theory and scientific testing, in the levels at which scientific testing actually is possible in financial markets. But that's a different story. Well, the thing is that they are saying that it's impossible to forecast markets because there are no patterns and there are no logic in the markets. What I'm thinking about it? Well, I would say they're almost right. My theory is that which says that in most times either markets are not going anywhere or everything you see is being priced into market prices already. And actually I have formulated my idea when I was in my early 20s, when I read a book Fooled by Randomness. And actually I would strongly suggest you to read this book Fooled by Randomness by Nassim Nicholas Taleb, because it changed the way I perceive markets and I think about reality and our own foolishness. He uses basically easy examples of financial markets in life, where he basically says we try to find patterns in random data and we shouldn't look at that, and our own ability to perceive reality and forecast future are effectively useless because we are lying to ourselves. That's a very oversimplified theory, but I kind of believe that theory. And I also believe that's why I also believe that markets are almost random, not complete random. Because if you look at objectively large market data, large amounts of data, you could see that, well, it's kind of not random. This is S&P 500 from 2011. How much does TradingView allows me to see? Yes, it is let's see, market data from a long time ago. This is not random pattern. It's if you could see that, this is not random pattern. You see that markets rise. If you look at 60s, S&P was 70. Now it's 4,500. So this is not a random pattern. It corresponds to growth of business activity in the United States, because the businesses have grown exponentially since the 60s. and now. Like, that's not random pattern, that's not coin flipping. And there are actually investing and trading strategies which are produced results which couldn't be possible to explain simply by random walk theory. For instance, the value investing, trend following, or arbitrage. These strategies are beyond chance and beyond the fact that someone simply just got lucky. Yes, in the short term, in 1 year or in 2 years, there will be fools that would be lucky because just because they have risked some risky asset and that asset rose into the high levels, like that was with crypto in 2021. But they are not random. They have long-term patterns and long-term principles how markets move. The thing is, you cannot predict them. That's the thing. The whole irony of financial markets is that there might be sense in the long-term market use, but you never know the magnitude and probability of when these markets move. So that's why I'm saying there is elements of truth in random walk theory, but in all essence markets are not random. Like, you see, this is not random pattern with S&P 500. If you correspond that with business growth, you will see that it reflects business growth, and if businesses will grow in America, S&P will rise in America. So that's the thing. If there would be shortages of oil price will rise. This is not random pattern. But the thing is, you don't know when will it rise and the magnitude of certain changes in asset prices. This is the random thing, as I just told you, and you have to separate between them. The whole idea, the whole principle that markets might move because of the supply and demand forces and whatnot, that's not random. Magnitude is random. Those two things, you separate them, you understand what's possible, what's not, then you might have something. And that's why I'm always saying in my videos and in my lectures and in my consultations, what matters is the magnitude, how much you win, how much you lose, and those probabilities. Name every successful investor, trader, who was successful in finance, he will answer you the same thing. He don't rely on market forecasts unless he sells them, but he relies on probabilities, how he maximizes his gains and minimizes his losses. That is essence of financial markets, because you cannot see or forecast anything. You just know the principle that's behind certain asset class. So I think I kind of give you my perspective of this theory, because, well, I wouldn't give you a lecture on what is random walk hypothesis or whether it's right or wrong according to like theoretical standards, which is like proposed by many academics. I could tell you my views, how markets work and how I perceive them, because what I believe that is, yes, there are no people who have made money at market forecasts for consistent basis, but there are few percentage of people who have made money consistently by maximizing their probabilities. That is the fact if you look at successful people in markets. That's my approaches in trading or investing. That's why I look at trend following or value investing, because they have those senses into their design. They don't rely on what will happen after a month or 3 months, which is completely random, but what will happen with asset class or asset itself, which is not random. So I hope this rather vague lecture gave you some sense and some understanding about this theory, because this theory is used by many academics, and probably I will get some big philosophical text about financial markets also later. So I hope you kind of liked what you saw and it wasn't too boring. So stay tuned and wait for my other videos. Bye.